Hello and welcome back to cryptocurrency trading, mastering scalp trading strategies by a wealthy education. In this video, we're going to talk about exponential moving averages. Now, a EMA is just a variation of an SMA. So what's an SMA? It's a simple moving average. So basically what happens is the indicator will kind of do one of these numbers here where what it's doing is it's plotting, normally it's the close, but it can be the high, the low, the open of each candlestick. And there is a periodicity to it. So, for example, like a 20 moving average would be the last 20 candlesticks, and it puts a dot, and then what happens is it connects all those dots and it makes a line. And what you're looking at is, like right here, this is the average price of the previous 20 candles. This is the average price of the previous 20 candles, and so on. And it does adjust over time because it's just the last 20 candlesticks. So as we print, in this case, another 5-minute polka dot candle, the back candle gets taken out of the equation and the new one is added. Basically, all it does is it gives you an idea of what the average is doing over time. Is price rising or falling? Are you in an uptrend, downtrend, that type of thing? An exponential moving average just does a mathematical equation where it puts more weighting, more meaning on the most recent candlesticks instead of just a simple, divided by 20. It may take the 20 and the last 5 are worth twice what all the other 15 are, for example. I mean, there's a million ways you can do it. But really all it does is it makes the market, or makes movement in the market show up in the moving average much quicker. So it's a lot more sensitive. There are a multitude of different moving averages. So let's click on indicators and moving average exponential. I already have it saved. You can just type in moving average and you can see there's a million different things that you can do, but moving average exponential. You click on that and a line appears. And this is an average of the last 9 candlesticks. 9 is a common one. So we'll click OK. I happen to have a couple here already. So this would be your 50. That would be your 200. So it's the last 200 candlesticks. 50 and 200 are pretty common for longer term. And let's put on another one that's pretty common. It'll automatically plot the new one at 9. That's the default. But let's change that to 20. And you can see that the 9 moves much quicker than the 20, which moves quicker than the 50, which moves quicker than the 200. So a lot of it's going to come down to how sensitive you want to be. There are a million ways to trade moving averages. However, one of the most common would be what they call a crossover system. And like on a daily chart, the quicker one, which in this case would be the 50-day, and the 200, the longer one. If the quicker one rises above the longer one, then we're in an uptrend. If it rises or if it falls below the longer one, then you're in a downtrend. There are a couple of terms that you may come across. This is a golden cross. When price is in an uptrend and it's confirmed by the 50 rising above the 200. And this is the death cross, which kicks off a big decline when the 50 drops below the 200. Moving averages can be helpful. Some traders will literally trade like this, and that's all they'll do. And that's fine, except for they tend to perform very poorly in like sideways markets. You can see where you would get chopped up. So let's get rid of the 200 and the 50. And so now let me change this a little bit. So let's make the 20, let's just make it a little easier to see. So let's make it like this aqua color. Okay. So you can see that the 9 crosses above it. It's a buy signal. It crosses below it. It's a sell signal. There are other ways they use it, though. For example, they'll use it as support and resistance. So if both of these are going down, then that stands to reason that it offers resistance, and that, in this case, polka dot would continue to go lower. When you get out, either when it crosses or price breaks above the moving averages. So that's one way you can do it. Let's take a look at BTC here. So this is where you have to be careful with moving averages. You see it's just kind of going sideways and it's getting choppy. What you want to see is a nice run like this, and you want to see the moving averages spread apart. When they get too close and noisy like that, then it can just get really choppy on you. So because of that, you want to see some type of angle. Most traders use them, at least that have significant amount of experience. So they look at this and they say, okay, that's dynamic support. Then what they'll do is they'll look to see if there's some type of price action in this area that perhaps gives you a reason to think that it's going to break down. Because if it doesn't, then the thinking is eventually the trend will continue. And you can see it does pull back and it continues. Let's take a look at, let's do link. Chain link US dollar. There we go. Kind of the same thing here. You can see that we crossed here and started to spread out quite nicely. And you would have gotten out here on a moving average crossover system. At the very least, you would have said, all right, fine. Well, we broke above these moving averages. And as long as we stay above both moving averages on, and a lot of times people will say on a close, then we're fine. Well, you get out there. Again, though, I can't stress this enough. You really need some type of trend. Sideways, no good for moving averages. But moving averages are pretty common. You'll see them in a lot of analysis. Again, it's a secondary indicator because really at the end of the day, you can take a look at this and go, well, there's obvious resistance there. There was support there that got broken, but we broke above this resist. You know what I mean? So you can go through and do your support and resistance studies, and you start to look at it. We plunged through there and we broke back above there. Well, so where's the next trouble spot going to be? Well, the next trouble spot's going to be somewhere in there. I'm tuned out. And look what happened. We broke above there and we found support, and then we continue to go higher. So, it's one of these things where you just kind of put it all together. And as we go through this course, you'll see more of that. Where, I'll say something like, hey, there's this pattern and the moving average is doing this and the Fibonacci is doing that. And they're all telling you the same thing. That's generally what trading is about. You're just trying to put everything in your favor. So in the next video, I'll run through some averages and it will discuss how to use this.